All right, today we're talking about a huge name in American energy, NextEra, ticker NEE. You've heard all about the AI revolution, right? Well, all that AI needs a massive amount of power, and that's put NextEra right in the spotlight. But here's the big question for you as an investor. Is the stock's premium price tag actually worth it? Is it a buy, a hold, or maybe even a sell? We're going to break down all the numbers and find out. So let's dive in.
Okay, here's how we're going to tackle this. First, we'll look at the bull case, the AI power play, and why NextEra is a renewables leader. Then, we'll flip the coin and look at the other side, growth versus valuation. After that, we'll dig into the financials, see what the analysts think is a fair price, and then we'll give you our final verdict on NEE.
All right, let's kick things off with the big reason everyone's so excited about this stock, the AI boom. And look, this isn't just some passing trend. We're talking about a fundamental shift in technology that is creating just an absolutely insatiable appetite for energy. And this really gets to the heart of it. At the end of the day, AI runs on one thing, electricity. A whole lot of it. Think about it. All those complex models, billions of search queries, all of that happens inside data centers that are just chugging power like never before. This isn't a short-term thing either. It's a massive, long-term driver for electricity. So that leads to the multi-billion-dollar question for investors, right? Who is actually going to power this future? Well, NextEra Energy is making a very strong case that they're one of the main contenders. Okay, so that's part one of the bull case. But here's part two, and it's just as important. It's not just about generating more power. It's about what kind of power. And this is where NextEra's big advantage comes in. They are an absolute giant, an undisputed leader in renewable energy. Just look at this number, $75 billion. Let that sink in for a second. That's the size of their capital plan. And this isn't just some number on a slide. It's a real massive investment strategy designed to do one thing: build out the capacity to meet all that new demand coming from AI and, the electrification of everything. And they're not just talking about it, they're already doing it. Right now, the company has a 30-gigawatt backlog of projects. That is a huge pipeline of new energy generation that's already in the works. It really shows you that they don't just have big ambitions. They actually know how to deliver on a massive scale. And here's what's really interesting. They're not just building the same old power plants. A huge chunk of that backlog, we're talking nearly a third of it, is in battery storage. Now, this is absolutely key. It puts them right at the forefront of modern energy, providing the kind of flexible power solutions that you need to keep the grid stable. It's a very smart move. Okay, but here comes the but. Every fantastic growth story has a catch, right? And for NextEra, the big question mark is the price. Is all this incredible potential already baked into the stock price? This is where we get to the other side of the argument, the antithesis. And this recent headline kind of says it all. The company missed its quarterly earnings forecast, the stock took a hit, and suddenly investors started asking some tougher questions about the company's financials, especially in the short term. And when you do take that closer look, you find something pretty telling. Analysts don't all agree, not by a long shot. Just look at the difference here between one fund's estimate for earnings per share, the company's profit per share, and what the rest of Wall Street is expecting. That is a huge gap. It really makes you wonder what next year's profitability is actually going to look like over the next couple of years. So, what do we have? On one hand, you've got this incredible growth story. On the other, you have some very real worries about valuation and profits. To figure out which side has it right, we've got to bring it all together and really decode the company's financial health. First up, let's talk revenue growth, year over year. I like to think of this as the company's speed on the treadmill. Are they speeding up or are they slowing down? It's a really basic but super important measure of how the business is doing. And you know what? On this front, the bulls have a really strong point. The company's adjusted EPS grew more than 8% last year. They even beat the high ends of their own forecast. So that tells you the growth engine is definitely still firing on all cylinders. But making money is one thing. Keeping it is another. That's why we have to look at net profit margin. This is pretty simple, actually. It's like your paycheck. It's not about your total salary. It's about how much you have left after all your bills are paid. Same for a company. And, this is where the story gets a little less rosy. Recent reports have been flagging something called margin compression. What does that mean? It means their profits are getting squeezed. So even though more money is coming in the door, rising costs mean they're actually keeping less and less of every dollar. That's a definite red flag. Okay, last but not least, let's look at the company's foundation, its balance sheet. And for a company that's planning to spend $75 billion, this is, well, absolutely crucial. We need to ask, is the company built on a solid foundation or is it sitting on a mountain of debt? And on this point, the jury's kind of out. Some analysts will tell you NextEra's balance sheet is a key advantage, but others are a bit more worried. In fact, our sources point out that some of their rivals have, and I quote, sturdier balance sheets. That basically means less debt. And when you're trying to execute a $75 billion plan, you need serious financial discipline. Any weakness here is a big, big risk. So the financials are a bit of a mixed bag, aren't they? We've got strong growth on one side, but then we have squeezed profits and some questions about the balance sheet on the other. So that leads us to the bottom line. What do the people who do this for a living think the stock is actually worth? Well, if you look at Wall Street's price targets, they're all kind of clustered together. We see the Henry Fund coming in highest at $96, BMO Capital at $93, and the general consensus is right around $91. What this tells me is that, yeah, analysts are optimistic, but they also seem to think that a lot of that amazing future growth is already reflected in today's stock price. All right, we've laid out the bull case, we've heard the bear case, we've crunched the numbers. Now it is time to weigh the scales and deliver our final verdict on NextEra Energy. So, after digging through all of this, what's the final call? What's the recommendation? Our verdict is a hold, and we're setting a 12-month price target of $96. Look, let's be clear. NextEra is a fantastic company. It is perfectly positioned for this AI energy boom. There's no doubt about it. The problem is everybody knows it, and those strengths are pretty much fully priced into its premium valuation. That just limits how much room it has to run in the short term. Now, if that high price tag makes you a little nervous, you do have other options. The sources we looked at mention companies like Constellation Energy and Southern Company. They're pointed out as having stronger balance sheets, which makes them a bit more financially resilient. So they could be a more defensive way to play the same trend in the utility space. So there you have it. That's our deep dive on NextEra Energy. The long-term story? It's incredible, for sure. But the current price? It just means you might need to be patient. Now, I want to turn it over to you. Which utility giant do you think is in the best spot to win the AI energy race? Drop your thoughts in the comments below, and hey, if you liked this breakdown, make sure you subscribe for more.